The UK government last week announced it will sell $4 billion of student loans through securitisation. Securitisation is a process where loans are packaged together and sold on as bonds of various levels of risk. In the case of student loans, the process goes something like this. The government originates loans to students. It then transfers those loans to what is called a special purpose vehicle, and the special purpose vehicle issues bonds. The people who buy those bonds are then getting paid based on the repayments of the student graduates. The government, which has been advised by Barclays on this issue for several years, believes securitisation is the most effective way of selling these assets. The government has said it is selling the loans to improve its finances, so it can spend money on more pressing policy areas. It aims to raise $12 billion in total from a series of sales up to 2021. These income contingent loans only get repaid when a graduate is earning over a certain amount. The loans will not attract their full face value, but are instead likely to be sold at a significant discount. The move has prompted a debate over whether these sales actually help the government's finances at all, given it is simply converting an illiquid asset into a liquid one, rather than explicitly reducing its debt. Until we know the exact discount, it will be difficult to say whether this is a good or bad deal for the taxpayer. The process will eventually create a new financial market for bonds backed by student loans. In the US, where levels of student debt are much higher, there is a $200 billion market for securities backed by student loans. In the UK, the creation of a market for private bonds, backed by these government-originated loans, comes as total amounts of student debt continue to rise. In England, they have more than doubled since 2011. The question is whether a student loan market, once it is up and running, will prove tempting for future governments looking to fund student borrowing through private sources rather than through the taxpayer. As such, it could eventually tie into a move closer to the US higher education model.